Hi, what I want to do now is to talk about how we'd account for non-monetary items which are purchased in a foreign currency transaction. The standard distinguishes between assets which are recognised on a cost or an alternative basis, and so we're going to focus in the first instance on the cost model. And the example we're going to think about is Bula Airways, which is an Australian company. It has operations in Australia, but it also has some terminal facilities in Fiji for handling freight. To support these operations, it purchases land. It purchased the land 2 years ago for Fijian dollars, 500,000, when the exchange rate was 125. So when Bula Airways purchased the land, it would have recognised the transaction as debit land $400,000 and credit cash $400,000, and that's how the land got into the financial statements for the general ledger for Bula Airways. At the 30th of June this year, the fair value of the land was appraised at $475,000 and the exchange rate was $1.27.5. And if we think about that, we can see that the value of the land has now gone down to $372,000. This might be considered an indicator of impairment. We'd do and be required to determine a recoverable amount, and that would form the basis for recognising an asset impairment. So just a reminder that Bula's adopted the cost model for land, and so what we'd have to do is, given we have an indicator of impairment, we'd calculate the book value, we'd work out the recoverable amount. The recoverable amount is less than the book value, so we'd recognise an asset impairment of $27,451. Now, there are two separate determinants of that change in value. One, the asset's gone down in value by Fijian dollars, $25,000, and two, the exchange rate has changed from $1.25 to $1.27.5. However, the standard says that we do not distinguish or decompose that impairment into its separate components. We simply treat them as one. And so what we'd recognise in the general ledger is an impairment loss of $27,451 in the statement of profit or loss, and we'd recognise an accumulated impairment. So what you can see is this very, very closely resembles how the land would be accounted for in terms of AASB 16, 136, or IAS 16 and IAS 36. So it's just adding a bit more information as to how you'd account for an asset which had been purchased in a different currency and was valued in a different currency. What if the what if the asset was a non-monetary item and the firm had the revaluation model? For the revaluation model, we can have the same basic scenario again. Bula Airways, it's an Australian airline that has terminal facilities in New Zealand for handling freight. This includes land purchased 2 years ago for New Zealand dollars when the exchange rate was 125. I've kept the numbers the same here. So the land would have been purchased initially as debit land, $400,000, credit cash, $400,000. At the 30th of June this year, it's in cycle for revaluation, and the fair value of the land is determined at New Zealand dollars 525, and the exchange rate is now $1.12. What this means is that the fair value of the land is $468,000. POR uses the revaluation model. It revalues land every 2 years, and so it has to do a revaluation for the land this year. What we can see here is that the land has a initial book value of $400,000. Its fair value in Australian dollars now is $468,000, so we've got to recognise a revaluation increment of $68,000. Now the key points to note here is that when you do a revaluation at year end, that's a year end valuation date, so you need to apply a year end exchange rate. And so what we'd do is we'd recognise a increment in other comprehensive income of $68,000, and we'd increase the value of the land by $68,000. Now, because we have only periodic revaluation, the land is going to continue to be converted at the exchange rate which was applied at the date of the revaluation until we do another revaluation. So you always have this correspondence between the value date and the exchange rate applied to that. You can't mix and